This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're now on the second chapter on foreign exchange risk management. And in the first chapter, we dealt with forward rates, money market hedging, and futures. Three ways of effectively fixing the exchange rate on a future date. Which is great in one sense, because obviously whatever the spot rate is now, we've no idea what it's going to be by the time we come to the date of the transaction. And so rather than leave it at risk, and we might do better, we might do worse, use forward rates, money market hedging, or futures, and we're effectively fixing the rate. Well, that's great. But suppose I told you I was pretty sure that although the rates change in the future, the spot rate, I was pretty sure it was going to move in our favour. And if it's going to move in our favour, well, why bother fixing a rate where those three methods we just mentioned, fixing a rate where we're not going to lose, but equally we're not going to gain. If it's going to move in our favour, it makes more sense, surely, to leave it and convert at spot and get the benefit. The only problem is, of course, we could be wrong. And however sure it's going to move in our favour, things may change, it may move against us, and then we have a problem. Well, in that sort of situation where I'm pretty sure it'll move in our favour, we've got a fourth method, which is rather different, foreign exchange options. And that's the main thing in this chapter. I'll mention a couple of other small things, but the main thing is foreign exchange options. And we spoke about share options in a much earlier chapter, and the principle's the same here. An option gives you the right to convert at a fixed rate on a future date, so far a bit like forward rates, but the right to convert at a fixed rate on a future date. But, and here's the big difference, it's our choice whether or not to exercise the right. So I'll illustrate it in a minute to make sure you all see what I mean. But we've got the right to convert at a fixed rate, but we don't have to. So when it comes to the date of the transaction, it's our choice. If the spot rate has moved in our favour, use the spot rate. Throw away this option. But if things have gone wrong and the spot rate's moved against us, fine. Exercise the option and convert at the fixed rate. And so, if you've got me, it is actually beautiful. But I'm going to illustrate with some numbers. But of course, just like share options, you have to pay for this right. There's a premium payable. Whether or not we exercise the option. So we'll pay a premium. It's a bit like taking insurance, really. You'll pay the premium whatever happens, and you pay the premium now as soon as you buy the option. If the rate moves against us and we use the option rate, then we'll be very glad we paid the premium. If, on the other hand, the rate moves in our favour and we decide just to convert at spot and not use the option, well, we may be a bit annoyed, but we'll still have had to pay that premium. So that's basically what happens. And let me get one thing out of the way, in case you're worried. When we did share options, we could be asked to calculate the value of the option using that Black-Scholes formula. With foreign exchange options, no. You won't be asked to calculate this premium. There is, in fact, a formula, but it's the Black-Scholes formula. It's more complicated. You're not expected to do that. Anyway, that's what an option is. However, there are two types. The first one is very easy. It's called an OTC option. And OTC means over the counter. And what an OTC option, it's a bit like what you might call a private quote. In that you go to the bank and you tell them you want the right to convert this much money at such a rate on such a future date. And they'll quote you a price, the premium. Let me show you what I mean. If you look at example 1, it's 1st of April. We expect to receive $2 million on the 30th of June. We know the current spot rate, but of course that's irrelevant. We're not going to be converting until the 30th of June. But we expect the rate will move in our favour. So rather than fix the rate at something, I want to be able to get the benefit of it moving in my favour. However, in case we're wrong, and it goes the other way, we've been to the bank and we've told them what we want. We want an option to sell $2 million. Remember, I've kept repeating this, we're always in my questions in the UK unless told otherwise. So we're in the UK, we're receiving dollars, and so we need, when we convert to pounds, we need to sell dollars to buy the pounds. So we want the right, the option, to sell 2 million on 30th of June at, and I've decided, you know, it may move against us, but I'm quite prepared to accept it moving to 1.52. And so I tell them what I want. They'll need to know the amount, they'll need to know the date I want to convert, and they'll need to know what rate I want to convert at. And they then quote a premium. And the bank has quoted how much? A premium of 50,000. Now, obviously, it's up to me whether I think that's fair or not, or I might go to other banks and see if they'll offer it cheaper. But if we accept this offer, we pay the premium immediately. Which is when? 1st of April. But we've now got the right to convert at that fixed rate, but it's going to be our choice whether or not to exercise it. So we then wait until the 30th of June. And on the 30th of June, depending on what the spot rate is, we'll decide whether to use the option and convert at 1.52 or whether we'd prefer to throw away the option and convert at the spot. And it says the requirement, show the outcome on the 30th of June if the exchange rate on that date is A, $pound 1.5180. Well, remember, we're receiving 2 million. I can either convert at spot, or I can use the option. And the exercise price on the option was what? 1.52. Well, which would I prefer? Think about it for a minute. But surely when we convert, we'll take the $2 million. There are 1.5 something dollars to the pound, and so we'll divide. Which would you rather do? It's a receipt, remember. Would you rather divide by spot at 1.5180, or would you be better off using the option? Actually, because we're dividing, the smaller number the better. We will convert at spot, and we'll receive as a result 2 million. We'll receive 1317523. We will not exercise the option. Think about it. If you'd exercise the option and converted at 1.52, you'd have divided by a bigger number. There'll be a smaller receipt. Now, although that receipt, that will happen on the 30th of June, do appreciate that even though we've not exercised the option, we will still have had to pay the premium. And the premium, the bank had quoted 50,000. And so, in the exam, you're expected to show the net outcome. The net result, although we won't exercise the option, we'll receive 1.3 million converting at spot. We'll have paid 50,000 for the option, and so the net result is 1267523. There's the net receipt. But do not make the point that although we're expected to show the sort of final outcome, make the point that the 1.3 million, that's received on the 30th of June. The premium, though, is always paid immediately you buy the option, which here was on the 1st of April. And so although we never bother in the exam, there is in a sense an interest cost. Pay part immediately, receive when we convert a couple of months later. But there's the end result, ignoring that timing problem. So that's what we do if the spot rate is 1.5180. We won't exercise the option, it's better to convert at spot. However, what happens if on 30th of June, part B of the question, what happens if the exchange rate, the spot rate, has moved to 1.6153? I can probably guess immediately, but again, we do have the choice. When we come to the 30th of June, we can either convert at spot, or we could exercise the option. The option was the right to convert at 1.52. Well, as I say, it may be obvious, but because we're receiving 2 million, again, to convert to dollars, to pounds rather, we'll divide by the relevant rate. And again, the smaller the number we divide by, the more we end up with. And so here, we will exercise the option. We'll convert at the option rate the exercise price of 1.52, and as a result we'll receive 1315789. That's what we'll receive on the 30th of June. But again, the premium will still have been payable, 50,000. So that's a receipt. The premium's always a payment. You pay for the option. And that will have been on the 1st of April. However, ignoring the timing difference, the net result, there's a net receipt of 1265789. And there we are. I mean, it's lovely. I think you've got to agree that if the rate moves, goes better than 1.52, we'll take advantage. We'll convert at spot. We won't exercise the option. If it's ever worse than 1.52, as it was here, exercise the option. And what we've ended up with, surely that is the worst outcome. Because if ever the spot rate in this question is more than 1.52, we'll exercise the option. So it doesn't matter if spot is 1.6, 1.7, 1.55, 1.9, whatever, we'll exercise the option. The worst that can happen is that what's there. If the rate is less than 1.52, then of course we'll take advantage of it and we won't exercise the option. So I think you'd agree that's lovely, but I hope you agree that's pretty straightforward. It's a private quote. I say again, you tell the bank how much money is involved, what date, whether you're selling or buying dollars. Obviously they'll need to know. You'll pay a premium either way, but they'll want to know whether you're selling or buying. And of course they'll want to know what exercise price you want. You choose the exercise price. And depending on the amount and the exercise price you've chosen, the bank will decide how much they're going to charge. And there we are. Just one tiny bit of terminology, but again, we have covered it on when we talk about share options. Here, we've got the option to sell dollars. And remember, options, if you've got an option to buy, we call it a call option. An option to sell, we call it a put option. Well, what I'm buying from the bank here, because I'm buying the right to sell dollars at a fixed rate, we're buying a put option on dollars. No problem there. All right, that's over-the-counter options. And, well, I should never say anything's easy, but I think that is pretty straightforward. I really do. And over-the-counter options do come up in questions. I mean, that's not going to be a 25-mark question, obviously, but as a part of a question, that could certainly be asked. However, where it gets a bit more complicated, it's what we call traded options. And traded options, as opposed to buying the option directly from the bank, an option, anything you want, they'll quote a price. Traded options are dealt with on the Financial Futures Exchange. And although the principle's the same, there are various rules go with it, particularly with regard to the premiums. Instead of going to the bank and asking for anything you want and they quote a premium, if you think it's too much, try a different bank and see if they're cheaper. With traded options, because they're sold on the futures exchange, there are standard premiums. You can look up the tables published in the papers, in the financial press every day, showing what the prices are. And so, just let me show you, first of all, the table, and then we can be able to interpret it, because these are common in the exam. And when they ask traded options, you do get a table, just like the one I've illustrated there. Let's make sure we can understand what this table is and the restrictions on us, and then I'll do a full question using traded options. So you've got there, I'm not going to write it up, the whole table on the screen, but you've got a table there. I'll write a bit of it. At the top it says dollar-pound options. We'll explain all of this, just let me write it down a minute. 31,250, brackets cents per pound. And then you've got a table where it has strike price, 1.425, 1.450, 1.475. And then you've got all those columns. An overall heading calls, whoops, March, April, May, and puts, March, April, May. Now, see, I'm not going to fill all the figures in. I mean, you should have printed out the notes so you've got them all there. But you've got a whole table, and that's how it appears in the financial press. That's how it appears in the exam. Well, look at example 2. Now, they won't ask you a question like example 2, but the answers to all those little bits there, you're going to need to be able to deal with them to be able to do a full options question. First of all, it says, what is the strike price? And you'll see there are 3 listed there, 1.425, 1.450, 1.475. Well, they are the various exercise prices available. So whereas with over-the-counter options, have any strike price you want. Any figure. 1.5, 1.3, 1.2, anything you want, and the bank quotes a price. With traded options, there's only a limited number of strike prices available, exercise prices available. In this particular table, we've got 3 we can choose from. But only those 3. If I want to use options, I use one of those 3. B, what do call and put mean? Well, we already know call is the right to buy. Put is the right to sell. But buy or sell what? Well, I should have done these in a different order perhaps, but you'll remember when we were looking at futures, there was a contract size. You had to deal with things in fixed size contracts. Well, similarly, with options, with traded options, we have to get the option on fixed size contracts. And you'll always be told the contract size. It's above the table. That, in fact, is what the 31,250 is. But the currency of that, here it's 31,250 pounds. Well, our call and puts are the right to buy or sell the contract currency. Which in this question is pounds. And so if we want the right to buy pounds, it's a call option. If we want the right to sell pounds, the contract currency, it's a put option. C, what do the months mean? Well, a little bit like futures, except they quote more dates. A March call. A call would be the right to buy pounds. If it's March, it's the right to buy pounds at the end of March. If it's April, it's the right to buy pounds at the end of April, and so on. Similarly, if we wanted the right to sell pounds, well, that column, the puts, would be the right to sell pounds at the end of March or April or May. Most importantly of all, D, what are the numbers in the columns? What does the 6.29, the 6.32, the 3.81, what do they mean? Well, they are the premiums. But I'll show you how we interpret it with a full question shortly. But the premiums are quoted as cents per pound. And so depending on how much we want the option on, do we want the option on £1,000 or £10,000? They'll charge us a premium, but the premium, if it's a March call, for instance, at 1.425, they'll charge us 6.29 cents for every pound. And so within that, I've already answered E. I don't need to write E down. 31,250 means that we must buy the option in units of 31,250 pounds, contracts. And again, the cents per pound, these premium, the numbers in the table, are how much they'll cost, depending on whether it's a put or a call, and depending on whether it's March, April, May, and depending on the strike price, the exercise price we want. That's how much will be charged at cents per pound. So I don't think that's too bad, but there's a bit of learning. And I say again, that's just how the table appears in the exam. In real life, there could be more strike prices available. In the exam, I think there's only ever been 2 or 3 available. But there we are. The exercise price, whether it's a put or a call, you're buying or selling the contract currency here, pounds. It's got to be a fixed size contract, so here 31,250. And the premiums, depending on the month you're going for, are quoted in cents per pound. All right. I just better mention over the page. You will remember again from when we did share options. There are 2 styles of options. There's European and American. I'm not going to write this down because it's the same as with share options and it's typed in the note. But with European options, you can only exercise the option at the end of the relevant month. So if you choose a March option, you can only exercise it at the end of March, or you've got the choice end of April, end of May, depending on what you choose. If it's European style, then a March option, you can exercise it any time up to the end of March, or the end of April, or the end of May. They're much more flexible and they cost more. Effectively, in the exam, it's as though it's European. Anyway, we need to do a full example explaining how they work. I've talked for long enough in this lecture, so I'll pause there, but the next lecture we'll use that table that we just had, but we'll work through an example showing exactly how the numbers work. It's not hard, but we need a little bit more thought, as you'll see, than over the counter, which are very straightforward.